All right, let's start with the next paper, which is called Trade War and the Dollar Anchor, presented by Tarek Hassan.
Okay, well, thanks very much. I'd like to thank the organizers. This is about trade war and the dollar anchor. So since April of this year, since Liberation Day, there are significant concerns about the US dollar's global role as safe haven and anchor currency. And there are questions about whether the trade war might be eroding the US dollar's exorbitant privilege. What we do in this paper is we evaluate the effects of a trade war in a risk-based model of the dollar's role as safe haven and anchor currency. So I'm going to present the model on one slide, and I promise one slide only. So this is the whole model. This is a completely standard model of exchange rate determination where I have two periods, and the only assumption I'm going to make is that there's a unit measure of households in the world, and the US is special because more households live in the US than anywhere else. So the US is going to be the biggest economy in the world, followed by the European Union, and then a bunch of other smaller countries. Households are going to invest in the first period, and all consumption happens in the second period. They consume a mixture of a traded good and a country-specific non-traded good. And I've thrown everything else out. The only thing left here is there's going to be a shock to preferences in the country. So a country is a place where everybody gets hit by the same shock. And if this chi is high for you, then you just want to eat more. Yeah, that's like a demand shock. Each household owns a firm that produces the local non-traded good using capital. And capital can be shipped only in the first period. So you have to form expectations and then invest accordingly. Households take prices as given and markets clear. So here's the insight, again, on one slide. So the universal prediction of this kind of model is that all countries are going to appreciate when domestic demand outstrips domestic supply. So in our case here, if you have a high demand shock, then your real exchange rate is going to go up. You're going to appreciate when people want to eat more. Now, the second kind of also near universal prediction of models of exchange rate determination is that in those states of the world, you're going to import more stuff. So when you appreciate, the same shock that makes you appreciate makes you want to import more stuff per capita. Now, what makes the US special is that more people live in the US than in other countries. So if I now look at the price of traded goods in the world, this lambda T here, when the US appreciates, they're going to suck in a lot of the world traded goods, and that's going to raise the price of traded goods in the world. So I'm going to have a positive covariance between the US dollar going up and the price of traded goods in the world. Now, if you do the same thing with a small country that has a weight of theta 0 here, then, for example, the Australian dollar, when it appreciates, Australians also import more, but that's not going to have any effect on the price of traded goods in the world. That's it. So therefore, the dollar, the currency of the largest economy in the world, is going to have a positive and higher covariance with the price of traded goods in the world, which happens to be the stochastic discount factor in this economy. So what are the consequences of this? And this goes back to my job market paper in 2013. 3 facts. Number one, the dollar is going to be the safest currency in the world. It's going to have a positive covariance with lambda T, with the price of traded goods in the world. Second, because it is safe, the dollar is going to have a lower interest rate than all other currencies, and that's basically applying some basic asset pricing to this covariance here. And number 3, interest rates are not just there for fun, but they allocate resources. So US firms, therefore, are going to have a lower cost of capital, are going to be more valuable than foreign firms, and therefore the capital in the first period is going to flow disproportionately to the US. We're going to have a higher capital to output ratio than we would otherwise have, and therefore US wages are going to be higher because of the US exorbitant privilege. 3 facts. Okay, so what do we learn? Dollar safety and the exorbitant privilege arise because US shocks have an outsized impact on the demand for the world's traded goods. Okay, now what does that mean for the trade war. Now, if you, in this model, now go and put a tariff on US imports, and let's say we put the same tariff on US exports, meaning the other countries retaliate, although that's not super important. If you put a tariff between the US and the rest of the world, you're going to dampen the effect that the US demand, when the US dollar appreciates, you're going to dampen the effect that US demand has on the price of traded goods in the world. So that means you're going to get rid of part of the reason why the dollar appreciates when the price of traded goods is high. Because now the US shocks spill over less to the rest of the world than they otherwise would. So in other words, in this model, the trade war basically looks like it makes the US smaller in terms of how much it knocks around the price of traded goods in the world. And therefore, it's going to weaken dollar safety. It's going to erode the exorbitant privilege. Now, if you take this model, and in all honesty, it's a little more complicated than what I showed you. If you fit the model to pre-2025 data on interest rates, currency returns, and so forth, and then say, OK, let's put a tariff of 17% between the US and the rest of the world, what happens? Well, in the model, we get US interest rates increase by 0.5 percentage point. The value of US equity in international currency decreases by 2.3 percentage points. And the volatility of the dollar exchange rate goes up. And it turns out that in April of this year, we saw all three of these things happen. Now, what is the prediction of the model? So a measure of a currency safety is just the correlation between the currency and the price of traded goods in the world. And I already told you that the dollar is the safest currency in the world in this model. Now we can see what happens at various levels of trade war to the safety, and you can see it erodes. So we think we're kind of here somewhere. And interestingly, you're going to see later that there is a point at which the euro becomes safer. What happens to US interest rates? So under free trade, that's over here on the left, we have the exorbitant privilege. The US interest rates is 2.5 percentage points lower than that of New Zealand and Australia, two developed economies that don't manipulate their exchange rate. Now, and you see, as you increase the tariff, the more you isolate the US goods markets from the rest of the world, the higher this interest rate becomes, and the lower US capital to output ratio, and therefore the lower US wages are going to become. So the trade war dampens the effect of US shocks on the world market, and thereby undermines dollar safety, raises US rates, the cost of capital, and triggers capital outflows. OK, so I haven't said anything about the anchor status yet. So what happens to the anchor status in the dollar's anchor status? So I'm going to summarize a paper that we had in the Restud in 2022 on one slide. So think about, in this model, exactly the same model, we think about now what would a central bank do if it has the option to stabilize its exchange rate against some target currency. So let's say in this model you are any country, and you can choose two things: the target currency of your currency stabilization, and a fraction omega by which you reduce the standard deviation of the real exchange rate relative to that target. Now, the key insight in this model is that small countries can inherit part of the dollar's safety and financial privileges by stabilizing their real exchange rate to the dollar. So if the dollar appreciates when the price of traded goods is high and you stabilize to the dollar, guess what? Then you also appreciate when the price of traded goods is high, and you make your currency safer. Making your currency safer helps you attract investment. So stabilizing to the US dollar lowers domestic interest rates, makes domestic firms more valuable, in this sense attracts investment from the rest of the world, and thereby shifts a larger share of world wealth towards your households. So you can actually show that under mild assumptions, that's an optimal thing to do. What you get out of this model, maybe a little surprising, is that you get the structure of the international monetary system endogenously, in the sense that the smallest countries in the world are going to have pretty hard stabilizations against the safest currency they can find, which is the US dollar. Now, as I go from the smallest countries to medium-sized countries, they're still going to want to stabilize against the US dollar. Not their neighbors, not their friends, but the US dollar, because that's the safest one. But they're going to have looser stabilizations. because as you get larger, it's harder to maintain stabilizations because you have price impact in the world market. So for larger countries, maintaining a stabilization of any kind is harder because they have price impact, and therefore they choose looser stabilizations or float. Now what you get then out of this model, I showed you, I plugged in some numbers. I didn't tell you what the numbers are, but I did plug in some numbers. If I now take the same numbers that gave me the reactions in April to the tariffs, and I ask in this model, what's the optimal stabilization policy? What I get here is, so I'm plotting the size of the stabilizing country on the horizontal axis, and on the vertical axis, I'm stabilizing the optimal strength of the stabilization. And what you find, number one, is that all stabilizations are against the US dollar, as I said. And number two is the smallest countries are going to have a hard peg. And then as the size of the country increases, they're going to have looser stabilizations, and only the largest countries float. This is like a share of world GDP here. Yeah, so now compare that to the data, Iletsky, Reinhardt, and Rogoff. And what you see is that this fits remarkably well, in all modesty. So the small countries stabilize hard, medium-sized countries sort of stabilize, and only the largest countries float. So I get in this model endogenously the structure of the world monetary system that we see. Now, what happens to the world monetary system if we start a trade war? Now, remember, the reason we stabilize to the US dollar is because it's the safest currency in the world. The trade war makes the US dollar less safe. So it poisons the anchor. It makes it less attractive to stabilize against the US dollar, and that's what you see here. So I'm plotting the stabilizing country's welfare, this is now for a small country of measure 0, over the size of the trade war. And what you see is that, okay, for free trade and moderately sized trade wars, you keep the dollar anchored. That's the best move here. But then, it turns out that there's a crossing point at 26% where the euro has a higher correlation with lambda t, and you switch the anchor. So if you now take this and kind of apply it to the different country sizes that we see in the data, what you get is a prediction of what happens to the structures, who stabilizes to whom, as the trade war escalates. And as I said, if you have tariffs of 0, you have free trade. This is kind of approximately the world that we lived in up until 2025. The smallest countries have hard pegs to the US. Medium-sized countries have soft pegs to the US, and only the largest countries float. This is weighted by country size here, so by share of world GDP. These are just 2, but they're big countries. Now, maybe today we're about 12% average tariff on US imports and exports. So as you go from 0 to 12%, some of the soft stabilizers float, and some of the hard stabilizers become soft. Now, this holds into the 20s, and then there's a flip. So if you exceed 26% in this calibration, it turns out that the monetary system doesn't unravel, but instead you just pick a different anchor, and this is going to be the euro anchor. So we're going to have looser stabilizations against a new target currency, which is the euro, and that consolidates at higher and higher levels of tariff, and that's because essentially you're removing the US from the world's goods market, and in the remaining rump of the world economy, the euro is becoming a larger and larger player. Okay, so let me conclude. So we introduced a model where dollar safety and the role of the dollar as the anchor currency arises endogenously. The US dollar emerges as the safest currency simply because shocks that affect the US move a larger share of global demand. Now, this safe haven feature is the key force that underpins the US exorbitant privilege and makes it the anchor of the global monetary system. Isolating the US from the world's goods markets erodes the dollar safety, and with it, the key financial privileges that come with the dollar. At an average tariff of 70%, you get a 0.5 percentage point increase in US rates. At an average tariff of 26%, you get a phase shift towards the euro anchor. Okay, thank you very much.
Thanks, Tarek. The first discussant is Jesse Schrieger.
So thank you so much to the organizers for the invitation to be here. It's a pleasure to discuss this paper. Let me actually begin by kind of placing this in the literature and really explaining why I like the key insights here. So there's now a large literature on the kind of asset pricing perspective on foreign exchange rate determination. So beginning with, say, Lustig-Verdelhan and Lustig-Rusnow-Verdelhan, there was a finding that what really can help us understand the movement of exchange rates is kind of a heterogeneous loading on global risk. When something bad happens in the world, we know that the Brazilian real is going to depreciate. We know the US dollar is going to appreciate. Work by Tarek and Murimano really shows us that this kind of heterogeneous loading on global risk is going to show up in persistent interest rate differentials across countries. Now, there's a large kind of search in international finance for, well, what's driving this kind of heterogeneous loading? So Tarek in his job market paper showed, well, one of the things it could be is country size, for the reasons that he went through in the presentation. Kind of other work by Rob Richman on trade network centrality, Farhi and Gebeks on heterogeneous loading on global risk. So that's kind of more on the international finance side of how can we find heterogeneous loadings and explain the cross-section of currency returns. In the Rees-Side paper that Tarek and co-authors have in 2022, what's exciting about that paper is they take that kind of asset pricing perspective but ask, what's the implication of that for macro policy? Okay? And the idea here is it's kind of a new way to look at pegging. That instead of, say, a commitment device for monetary policy, what it's about is we are going to adopt the stochastic properties of a particular currency in the world. Okay? That's really the key insight of that paper. So what comes in this paper? It's the idea that, well, one way in which tariffs are going to change the international monetary system is by changing the stochastic properties, the risk properties of the US dollar. And thereby, it's going to change the incentive of every country around the world to anchor to the US dollar. Okay? So let me give kind of the key mechanism of this paper here. So you can write the global stochastic discount factor, lambda j, kind of the international price of traded goods, as basically the weighted sum of supply forces and demand forces. And so the key is that, so here that yn that Tarek didn't show, that's kind of non-traded good output in every country in the world. Chi is the demand shock in every country in the world. And in the baseline of the model that Tarek showed, there was no bar. It was just theta. Every country is weighted by its size. So how much does world output of non-traded goods usually fall? Well, it's how big is the country times how big is the shock. It's the average. What happens when there's tariffs? We no longer measure countries by their actual size. We calculate their effective size. How big are they for the world economy? And so there's really nice expressions in the paper. You can actually write out what's the relative, what's the effective size of the US? In the denominator there, you see that little tau. If we have no tariff at all, we go back to the effective size of the US is the actual size of the US. Tau goes to infinity. The US is totally segmented in goods markets. It has an effective size of 0. How about every other country? Well, tau to 0, every country is its natural size. Tau to infinity, how big is any country? It's just how big it is divided by the size of the world economy, excluding the US, because the US is completely out. Now, in this world, who covaries the most with with global risk? So here I'm looking at non-traded goods. What's the covariance between the global SDF and output in any given country? Well, it's essentially just the country size times the variance of the shock. So what gives you a low interest rate? If you appreciate in bad times. What are bad times? Low output. So suppose that you are a small country somewhere in the world and your objective is to get the lowest interest rate. You then peg to the currency that would basically appreciate the most in bad times. And so then to this calculation of when does the international monetary system flip? It's just a question of when is the effective size of Europe bigger than the United States? What is that kind of critical tax rate where Europe is bigger in world markets than is the US? Now, what's nice is you can actually solve this out. It's a really simple expression just in terms of the traded goods share and the coefficient of relative risk aversion. In this simple case, in fact, you would actually have that the switching tariff is actually 200%. Now, what Tarek emphasizes is they estimate that it's actually only 26% for the world to flip. And that really depends on something Tarek didn't talk about, which was the degree of segmentation in international asset markets. So this really relies on only 3% of households actually trading financial securities. And so one thing I'd really like to understand is kind of why this magnitude is so dependent on the nature of the asset market, because the intuition of when you flip your country size is kind of so clear. Okay? Now, the idea here is when you raise these tariffs, you're going to change the risk properties of the dollar and dollar-safe assets. So where are we now? I wanted to just kind of present a few measures of kind of the state of dollar safety. So first, this is just the benchmark failure of covered interest parity. So how much would you rather own a US dollar asset versus a synthetic dollar asset hedged in securities markets? And so you can see that especially for 3-month bills, the dollar is still special. We still have covered interest parity, failing, and that hasn't gone away with this recent tariff war. We see the exact same thing even for longer securities. So benchmark, kind of risk, risk need for the dollar, we see that the dollar is very special compared against a basket of G10 currencies. What happens if instead you look at, say, the relative specialness in international markets of treasuries? How much would investors rather own a US Treasury than a synthetic US Treasury, where you take, say, a German Bund and you convert it into US dollars? Here you can start to see for the first time a real erosion of the specialness of the US dollar. So you can see that treasuries have essentially lost their specialness against a basket of other currencies at the 3-month horizon, and it's actually gone quite negative at the 5-year horizon. But what the paper is really asking for is how is this risk, how is the loading on risk changed? And so here I'm kind of looking at motivated by some empirical work Tarek didn't have a chance to show. How does the loading of, say, the dollar on global risk? Here I'd look at the change in VIX, change over time. So you can see here that if you just look at changes in the broad dollar, its loading on VIX, it still looks as if the dollar appreciates in bad times, the reaction around Liberation Day notwithstanding. When you look at the loading of covered interest parity on changes in the VIX, you still see that the dollar looks special, Liberation Day notwithstanding. Where you can really see kind of a change in the role of safe assets for the US is the loading of kind of the specialness of treasuries on global risk, where it went from 5-year treasuries being gaining value relative to other safe assets in bad times, just going back to 2012. That's really flipped negative. And that big drop down in the beta there, even though this is a 2-year window, that's really driven by Liberation Day. So in terms of are we seeing some of the mechanism put forward, I'd say we're seeing it a bit in treasuries. It's a bit harder to see in the dollars itself. So now, coming to the analysis that Tarek discussed about the switch to the euro. One question I want to raise is, do we really think that the plausible alternative for the national monetary system is the euro? So in the model, the only thing that should determine the anchor size is relative country size. So when the authors calibrate to 1984 to 2019, the average, you have the US at 27, euro at 15, China at 7. But even when they do their 2023 calculation, China's already second at 17%. But that won't change the analysis. I think more importantly, if tariffs destroy dollar centrality, this is a regime shift in the entire international monetary system. I think rather than kind of a smooth transition, we're in a new world. So I want to raise the question of, when the system gets remade, would China be the more natural replacement as the rising challenger? And I think this is a case where a static model may make it a little bit hard to see. Why? Because in a static model, you would just have to say who's biggest at the time. But if you imagine that countries differ in their growth rates and China is faster growing, and it's not easy to switch your anchor currency year after year, that may be a reason why we actually would see the renminbi as the alternate challenger. Now, clearly from the perspective of the US administration and President Trump, that is what's in his mind. So this is kind of a quote from actually after the election of how the US could apply pressure to support the dollar. So the President says, the idea that the BRICS countries are trying to move away from the dollar while we stand by and watch is over. We require a commitment from these countries. They will neither create a new BRICS currency nor back any other currency to replace the mighty US dollar, or they will face 100% tariffs and should expect to say goodbye to selling into the wonderful US economy. Okay? And so in this world, we see tariffs, in the presentation Tarek gave, tariffs necessarily erode support for the US dollar. Is that necessarily always the case? And so one question here is, suppose the United States wanted to use kind of geoeconomic power to pressure other countries to stay on the dollar with tariffs. Is that actually something that, in the context of this model, is feasible? I would say actually yes. So one thing that you could imagine happening is that the threat of tariffs, this this, unless you stay connected to the U.S., you face, higher prices to sell into the U.S. That could be one way in which the U.S. compels countries to not divorce. Now, when you think about that as a policy, you might think that the more countries that are pegged to the dollar, the more tempting it is for other countries to stay pegged to the dollar. In the context of the current model, that's not actually the case. And the reason is, the more countries are pegged to the dollar, the more countries are actually selling insurance against dollar risk. The less risky the dollar becomes, the less interest rate benefit you have. And so one thing I'd encourage the authors to look at is, suppose there are strategic complementarity or network effects in currency. I think you might end up with a little bit of a different reaction to how tariffs could work. I think one thing that actually comes out quite clearly from the model is how it might actually work if the United States was concerned that China was the rising threat to the dollar. Suppose that instead of what President Trump said of tariffs if you move away, suppose the ask is other countries putting tariffs on China. In a world where tariffs of like-minded countries went up against China, how would that change the international monetary system? One of the things that comes out very clearly from this model is that these barriers to trade are going to reduce China's effective size in the international monetary system. And so this is kind of another channel where tariffs don't necessarily move the dollar. Now, is this a good idea? I'd be far more inclined to use kind of positive inducements to stay on the dollar. And I think that this is a case where you could imagine a world of tariff cuts for dollar use, or I think more plausibly, here in this paper, there's no discussion of the ability to commit and sustain a peg. I think in many cases, countries are worried about, say, a speculative attack on a fixed exchange rate regime. The United States very much has the power to make it easier to sustain a connection to the United States. We see this with the swap lines offered to Argentina yesterday. And so you could imagine that the United States has quite a bit of tools to sustain the role of the dollar, even as China's relative size is growing. But now, does the US even want to be the anchor currency? So I'm going to leave reality for a second. In the context of the model, it's really not clear. There are two offsetting effects for the United States. The US does enjoy being the anchor currency because it's every country around the world selling it insurance for free. It's making the US less risky. However, as you get, as you basically insure yourself, what does that mean? You pay a higher interest rate and you have lower capital. And so in the model, it's very much going to be dependent on where in the parameter space you are, if you even want to be the global reserve currency. Now, the final point I want to make here is kind of what looks like an innocuous assumption in the paper, but I think is actually, and pretty standard assumption, but I think is becoming more and more pressing as we see the US fiscal position. In the model, tariff revenues are remitted lump sum to household. In reality, this tariff revenue is now filling in such a large part of our budget gap that it may matter for the role of the US dollar in treasuries. And so right now, I wouldn't say that the US is necessarily dependent on it, but one question going forward is, where is the revenue coming to replace this kind of new tariff revenue, and how would that actually interact with the barriers coming with tariffs? So to conclude, I really think this paper has an important key idea. Tariffs change the stochastic properties of the dollar. That affects the incentives of the rest of the world to peg. Focusing on pegging, I think the same forces should apply to borrowing, lending, invoicing in US dollars. And then some questions looking ahead. Are we seeing a change in the specialness of the dollar, treasury, or both? I think we're seeing a bit more in the treasury than dollar, but it is too early to say. Is the natural rival of the dollar to supremacy the renminbi or the euro? How can the United States sustain the era of dollar dominance, especially in the face of a rising China? And then, does the United States even want to do that? So, thank you very much.
Thanks, Jesse. The second discussant is Linda Tisar.
Okay, I'm delighted to be here. I know every discussant typically says thank you for the opportunity to read and think about this paper, but I really mean it. I had a really great time. At first, I fought it because it's so simple and so, I mean, it seems complicated, but when you strip it down, it's so elegant and so simple. And then I didn't like it because I thought, well, that's way too simple. But it's a useful benchmark for thinking how far do we think we can go? And I have to say, these guys really push it very far. I'm not sure I'm willing to go as far as they are to ask all the questions they ask, or I think that it answers all those questions, but it's a great starting point. Okay, so the question is the dollar status as the world's global anchor in jeopardy? I can't think really of a more timely and important question. The motivation is the announcement of U.S. tariffs on so-called Liberation Day that triggered a decline in stock and bond returns. And on that day, the dollar depreciated. Now, this is sort of unusual. This caught everybody back a bit, because typically when tariffs are imposed, this reduces demand for foreign goods, and so you tend to think, oh, this is going to lead to an appreciation, not a depreciation. On top of that, there tends to be a flight to safety in times of turmoil, and this was certainly a time of turmoil, and again, that would have led to an appreciation of the dollar, and instead it was a depreciation. So it's caught everybody back, and is a great motivation for the question, is this the beginning of the end for the dollar? So this is a very stark model, very simple, and I think it's worth just kind of walking through the basic pieces. It's static. Now this is key because kind of bonds and the dollar are kind of the same thing here. So there's kind of a slippery slope, which I struggled with a bit between, are we talking about the role of treasuries as the global safe asset? Are we thinking about the dollar as the world's anchor? It's kind of all tied together because the model is static, so these assets are kind of the same thing. So we've got households here that consume a traded good and a non-traded good. We've got productivity shocks that can affect the local supply of the non-traded good, and we've got preference shocks that affect the demand for this aggregate traded, non-traded composite good. And they've got the model written down in different ways, but this is the way it comes to the same thing. You'll see in a second. And countries trade assets then and a homogeneous traded good. And trade in goods basically help insure households against local shocks. And households need currency then to buy this traded good from other countries. And the real exchange rate then, we're really talking about the real exchange rate. The real value of traded goods is going to be conveyed in this real exchange rate. And households are going to have different valuations initially because they're subjected to these shocks, and this is going to affect the marginal utility of the traded good. And it all kind of boils down to two equations. The top equation is the real exchange rate, that's SF, and the bottom one is this going to end up being the global risk factor, but it's really the marginal utility of the traded good at every point in time. And what you can see here is there's two factors that affect the real exchange rate. When output of the non-traded good is low, that's going to increase demand for the traded good because I want to compensate for the fact that I don't have as many non-traded goods. That's why there's a minus sign in front of that coefficient. That's going to cause the exchange rate to appreciate. I'm going to want to buy more of goods from the rest of the world. At the same time, when the demand shock is positive, I'm also going to want to buy more from the rest of the world, and that's also going to push toward an appreciation. Now, at the bottom, we've got the world's desire for the traded good, and that also is going to be high when supply of non-traded goods is low worldwide, or when demand for traded goods is high. So you can see we've got these kind of correlated factors there, basically relative supply and demand, and they show up in both this global risk factor and the real exchange rate. And so there's this common driver, and Tarek did a great job presenting this, and so did Jesse, but there's a common driver of both of these components, both of these factors. The global stress factor, though, depends on global conditions. So, and the top one depends on local conditions. So what this means is that size matters. The bigger is the US, the more it's going to have an effect on the exchange rate, and at the same time, the bigger of a weight it's going to have in that global risk factor. So size matters. What does a tariff do? Just super intuitive. The tariff is basically going to put a wedge between kind of the true size of the US economy and its effective size. In other words, it's going to reduce the weight of the US in that bottom factor, and it's going to weaken that covariance. That's the key to the whole thing, okay? Okay, so for one thing, I'm going to start by taking the model literally, okay? So literally what the model says is that big countries are safer in the sense that they have a larger impact on the shadow value of the traded good, and their currency will tend to appreciate when times are bad, when demand is greater than supply. Now, is it just size? I mean, does this mean that China is going to automatically grow into being the world's safe asset? Even the authors say in the paper, no, we don't think so. China has capital controls. We don't really. Well, right there, it's telling you there's more to being a global anchor than size. There's other things going on, and that's kind of where I want to go. From a risk perspective, even if we take trade per se as the key driver here, is it just trade? I mean, if we think about trade, is it just the volume, how much we buy? I mean, we have to imagine that there are choke points in the economy. We have supply chain issues that being cut off from critical supplies at critical points in time are going to affect the riskiness of a currency and the riskiness in the economy. So I think even trade isn't quite that simple. I think the model also implies a really strong overlap between the timing of flights to safety and what's going on in the United States. Now that's true a lot. When the US goes into bad times, it's bad for everybody. But it's not always true. There are lots of shocks that lead to global volatility that stem from outside of the United States. So I think, again, just taking the model on its own terms, we can think of ways we could extend this and think, it's a little too simple. I also think, another strong prediction of the model is that, when tariffs were imposed, this is really bad. This is bad for the local economy, and it's going to decouple us from the rest of the world. This isn't exactly what we saw. And again, there's a little bit of a wedge here between U.S. assets and the health of the U.S. economy and the U.S. dollar, or the return on U.S. nominal assets. So, for example, recently what we've seen is that U.S. companies are doing fine, and foreigners are investing a lot in U.S. companies. What they seem to be worried about is holding the dollar. So you can see over on the right, you can see that these ETF funds, for the first time in a long time, are actually hedging their U.S. position. They want to hold U.S. assets. They're worried about the dollar. I also want to, there are a lot of papers that look at the attributes of, that talk about safe haven assets. And I think lots of currencies are raised up as potentially safe haven assets. And I have a student who wrote a paper. He had a different way of identifying when flights to safety occur. And, for example, Switzerland now and again emerges as a place where there's heavy flight to safety, and it emerges as a safe asset. But do they become a global anchor? And I think it's because, no, and it's because there's more to being a global anchor than just you have the right covariance properties at particular points in time. For example, why isn't the euro likely to emerge as the global safe haven anchor currency? Well, even Madame Lagarde has said that a key barrier to that is the liquidity of the Eurobond market. That, yes, there are a lot of Eurobond assets out there, but they're issued by different countries, they have different risk characteristics, different liquidity, and so there isn't an obvious substitute for US Treasury. So even the euro, which is probably the next currency possibly to step in line, is a few steps away from really being a safe haven asset. The other thing I want to raise is, was the market response to Liberation Day, was it really about trade? Is that what we were really reading about in the papers? For sure it was. We were worried about tariffs. But if you look at headlines from the time, this is the Wall Street Journal, what the Trump dollar plunge means, are investors losing confidence in U.S. economic policy? Trump tariffs aim to bring down a curtain on the era of globalization. After tariff shock, Trump may weaponize finance against allies. Sell USA, why Trump's tariffs may spark a historic storm on Wall Street. I think they were worried more than, tariffs were maybe the tip of the spear, but there was a real worry about where this is headed that was really unsettling markets. And so I think looking ahead, if we think about, and now I'm going way beyond where the paper is, but if we think about what the threats to the dollar might be, I think it goes beyond tariffs, and it goes to, what if there really is a commitment to the implementation of the Mar-a-Lago Accords? The tax on Fed independence are a threat to the dollar. Tax on foreign investors, hostile conditions for foreign firms and the workers that work in those firms, rising public debt, persistent U.S. policy uncertainty, changing geopolitical alliances and the ability of our financial regulations to keep up with them. I think these are all things, and they're obviously well outside the model, but I think these things go to maybe more so than pure tariffs to threaten the status of the dollar. Now, regardless, these threats are rising, but I don't know that the dollar is going anywhere immediately. We've been talking about these kinds of threats for some time, and of course, the dollar remains, it's in its dominant position, although we do see countries diversifying away in their FX reserves. So just to conclude, I think taken on its own terms, I think this is a brilliant paper. It's a simple model. It highlights key linkages between trade and risk sharing. It delivers stark predictions for the exchange rate, the interest rate, and demand for U.S. assets. I think of it as a benchmark from which we can kind of think about this is things stripped down to their essence, which is not easy to do when you think about questions around the global anchor currency and financial markets. So I think that's brilliant. But, is this the only or even the best framework for thinking about the safe haven status of the dollar? I'm not sure, but that's a pretty tall order to fill. So I think it's a bit of an unfair standard. So I think, the dollar remains dominant, but the foundations under the dollar may be cracking, partly due to tariffs, but partly due to a lot of other threats. Thank you.
Thank you. Thanks, Linda. I think Shebnam has a question.
Great paper and great discussions. I would like to pick up on Linda's last point, and there were just several shocks happening in April, right? And I would put in terms of dollar depreciation and are we at the start of losing the safety status, the policy uncertainty, especially trade policy uncertainty and the general economic policy uncertainty to the top. If you look at the Steve's and Nick's index, both trade policy uncertainty and economic policy uncertainty is just like skyrocketed. And it is also volatile, right? So in that sense, is there any way to separate the safety side from just this like huge increase in policy volatility affecting the depreciating the dollar? For example, during the Middle East and the Iran bombing and all, dollar appreciated again, which tells you that safety is pretty much there. So that would be very, very interesting, like to really kind of separate that whole policy uncertainty, depreciating the dollar versus maybe the other side still keeping the safety. Thank you.
So we'll go to Jay Shamba and then Dong Khon.
Thanks. I largely agree with everything Linda said, but I have a couple nuances to add. So first, in large part, because it's a really cool paper and it's really fun, and so it's and I also agree with the results that chaotic trade policy may undermine the safe haven role of the dollar and change exchange rate regimes. But like Linda, I do have questions about the mechanism, and in particular, if I think of what it means to be a safe haven, I'm not sure it's appreciating when the price of traded goods goes up. It seems like it's a lot more about risk aversion goes up, uncertainty goes up, all these sorts of things. So you still got the same thing like the Lustig and Verdal hand, like marginal utility of consumption is higher, and it's the same properties. But those things, again, seem to tie much more to your asset market properties than your size of trade in the global market. And it's a lot more about, do you have liquid markets, depth of market, et cetera. And that's why you could get countries like Switzerland and Japan actually being even more of a safe haven than the United States in terms of how they appreciate relative to global risk. The second thing was, Regarding kind of it's not just the covariance as to why countries choose to peg to the dollar. If you actually talk to countries, that is their least favorite part of pegging to the dollar. They hate appreciating with the dollar when it appreciates in bad times. And they will explicitly tell you this if you're working in the US Treasury. And Vietnam was thrilled to have depegged to the dollar right before the dollar got stronger in COVID and things like that. And it's because they don't want to appreciate in bad times. They want to depreciate in bad times to be able to sell more of their goods unless they're really short foreign currency, in which case maybe they don't. But that seems, again, to just connect to this idea that it's not just about the covariance, it's about other stuff. It's about being tied to this incredibly deep liquid financial market and having all these savers who like to save in dollars. And so if you peg to them, you get all your results, which I do agree with, that by pegging you can lower the interest rates and things like that. Thanks.
Don Cohen, then Ben Harris.
So one of the unusual things about these tariff agreements is that they come with enforced investment in the United States. The UK and Japan have agreed to invest hundreds of billions of dollars in the US. And I wondered how to think about that in regard to this. So in effect, the US seems like it's trying to capture more of the global capital stock with these forced investments. And then you have things like stable coins, where people think that will increase the demand for U.S. Treasury securities and demand for dollar assets, dollar-denominated stable coins. So there are a bunch of things going on that feel like they're contra, to some extent, to the disruption of the tariffs in terms of the capital investment and the demand for U.S. assets.
Ben, and then Rick Mishkin.
So let me just ask a question out loud that I hope is not construed as support for higher levels of tariffs. But when you think about macro stability risk, we have two big vehicles in the United States. We have an FOMC, which meets 8 times a year and often takes no action and is bounded by the zero lower bound. And we also have fiscal policy, which at best you get one reconciliation package a year and has mixed motivation. Thinking back to like 2010, when I think Republicans in the House were perfectly happy for the United States to have slow economic growth. The tariff regime, as we've discovered the past few months, is incredibly flexible, can turn on a dime, and seems to be driven by a motivation. Well, I don't really know what the motivation is, but could in theory be driven by a motivation for greater macro stability. And so because you have, in effect, what looks like a sales tax on certain goods that can be changed very quickly, are tariffs actually a new tool for macro stabilization if used right?
Rick Mishkin.
So I think when you think about what's been happening in terms of this administration, the tariffs are also an aspect of not about trade so much as an exercise in power. So you don't like a particular policy, you put a big tariff on the country to punish them. So classic example here is Brazil, where they want 50% tariffs because they've been nasty to Bolsonaro. So in that context, it actually can create a tremendous amount of uncertainty, which is not in this model, because you just pick a particular level of the tariffs. And I think that would actually mean that you have another aspect which makes the currency less safe, and that would mean that you don't even have to have as high tariff rates in order to actually get this switch.
Neil Marocha.
So I think one of your main results is that interest rates might be higher due to the increase in tariffs. But it seems important here to think through the dynamic effects in a world with capital markets and investment goods. In that world, a tariff looks like a negative productivity shock and is going to depress investment demand globally and can have sizable effects on interest rates that may be as big as what you're finding.
John Steinson.
So an important fact about the world over the last 75 years is that the largest economy in the world supported free trade. Now, if you think about what our trade economists teach us, a basic fact in their models is that the largest economy in the world has the strongest incentives to impose tariffs because of terms of trade effects. And so I guess it's kind of like a puzzle from the perspective of trade economists, that the largest economy in the world supports free trade. And so I found the perspective in this paper to be, a very interesting perspective, because it kind of, that argument is being made by the trade economists to support the notion that the U.S. should have tariffs, or at least that's an argument in favor of it. But this paper, I thought, provided a very nice, counter-argument to that very basic argument from trade theory that a large economy should actually impose tariffs.
Gabe.
One of the things I find regrettable about some of this administration's macroeconomic policy is it does so many things at once that it's hard to separate out as a researcher what is what. That's where high frequency is very useful, and the April asset market returns are very useful. As a request maybe to the editors, the Supreme Court's going to hear on November 5th the case on whether these tariffs are in fact constitutional. I think they may find if they're not. That would be a very nice second test of asset market returns and what happens with your model, and it would be wonderful to maybe extend the deadline for this paper to incorporate that evidence.
I thought you were going to ask us to slow the world down, Gabe. Ben Bernanke.
Enjoyed the paper. There are arguments I associate with Pierre Gouvernail and others that the way the U.S. provides insurance is by issuing bonds. It has to do with the liability and asset structure of the country. We issue bonds and we hold equities abroad. And so in bad times, we're insuring the foreign investors, and we're taking the losses in the equities. I just wondered if somehow or another this model could be jiggered to kind of give you that result if there's an endogenous asset decision.
Penny Goldberg.
I very much agree with all the comments that emphasize the role of uncertainty. That said, I want to make an argument in favor of the mechanism highlighted in the paper. On April 2nd, when the tariffs were announced initially, for a day it seemed uncertainty was resolved, because at least for a week it seemed we would know what tariffs would be in the near future. And at that point, there was no prospect of negotiation, bilateral negotiations in reducing the tariffs. And that's when the dollar really depreciated. So it was a statement on the US part that we want to decouple from the world economy. And the exchange rate did react to that, as predicted by the paper. And of course, what followed was very different from what was initially announced. And all these questions about uncertainty became very relevant.
Joe Stiglitz.
Yeah, I think the point that was made before, that this is a static model, and one really needs to view exchange rates in a more dynamic capital market. And when you think about one aspect of being the anchor, it's that it's used as a reserve currency. And when you think about it used as a reserve currency, that's an important driver of capital flows, and those capital flows are part of the general equilibrium and have a first-order effect in the determination of exchange rates and in U.S. macroeconomic policy, so and macroeconomic effects. So, being a reserve currency has some big disadvantages because it means that we have to run trade deficits when other countries want to hold U.S. dollars. And so that really affects the stability of the U.S. economy. And you see some of this, the point that was made before by Jay about how other countries view being anchored to the dollar. Argentina being anchored to the dollar in the period after the 90s, after 1989, and basically the collapse of the Argentine peso was because of the strong dollar. Ecuador, a very small country, also had enormous problems because it was anchored to the dollar. So anchoring to the dollar, both for small countries and medium-sized countries, has proven very problematic.
Okay, Yuan Chen, Yang, and then Christy Romer.
Yeah, another point I think is worth considering the difference between announced tariffs and actual tariffs, because while tariffs were announced at high levels, but there were exceptions on Apple product from China, for example, and the USMCA. So perhaps the effect on dollar we've observed comes from uncertainty or anticipation rather than the actual implementation of these tariffs.
Okay. Christy and then John Holtwanger.
I just want to follow up on something that Penny said, because I agree with you that on Liberation Day, maybe some of the uncertainty about tariffs were resolved, but I think what the policy did was to raise concerns about every other policy that might be coming out of the government. And so the risk that we were going to have crazy fiscal policy, attacks on the Fed, I think the perception was maybe all of those things went up on that day. And so I think that just kind of echoes, I think, what Linda was saying, that there's so many other things going on that were probably affecting those things.
John?
So one very different thing is to talk about the impact of trade and I'll say misallocation. So I thought what I learned from Mark Mellitz and all the international trade economists, that really the big push for free trade is we improved allocative efficiency, not only in the United States, but around the world. And U.S. on many different policies has sort of been the beacon for trying to keep the economies dynamic and flexible and without lots of misallocation. To me, lots of these policies, the uncertainty, but also the tariffs themselves, are increasing misallocation in the United States on many different dimensions. The U.S. was a place people wanted to do business, partly because we were this dynamic, flexible economy. I think that this pushes against that.
Okay. Let's go back to the authors. You have a lot to respond to, but you have a little time, and maybe you can break the comments into themes so you can address a few at a time.
How much time?
You have 15 minutes.
Oh, okay, fine.
Yeah.
So
if you don't use it all, we could go back for more questions.
Yeah, okay, so let me try and, so first of all, I'd like to thank the discussants for fantastic discussions and also their patience with us in this process. So let me I want to first say something that is cutting across a bunch of the comments. This is a static, very simple model because, it's nice, but we also don't know how to do the dynamic, complicated model. So I just want to kind of comment in this sense on the state of the literature. As Shabnam is sitting there, we've been banging our heads against the wall for many years, trying to essentially create a synthesis between international macro and asset pricing. And the reason we believe that is so important to do is because you can get really fun results like the ones that we just showed you. But also because we think things like the global financial cycle and sudden stops and many, many other things about the effects of uncertainty on the world economy are important things. And I just wanted to note that the professional rewards, having educated basically students on the international macro textbook and the asset pricing textbook, and having tried to stick these two things together, the professional rewards for doing this are very low. So I just wanted to, just in general, maybe if you thought this was interesting, generally maybe be a little bit more patient with your students, because if you try to stick these things together and all of a sudden things that work in one setup don't work in the other setup, and okay, so I'm going to stop talking about this now. But that's basically the state of the literature, right? We're doing this simply because we don't know how to do the big beautiful model. So for Jesse's comment, so why is Tau crit? So why is this kind of switching tariff so dependent on market segmentation? So let me tell you how we resolve the sticking together problem here. So there's a fundamental issue in traditional macro models that risk premia have zero effect, right? Because they're small. Yet we were able to write a model with constant relative risk aversion here, and that looks fairly realistic, where the risk aversion really does something that sounds like it's realistic. And the reason we were able to do this is by assuming that only 3% of world GDP is engaged in arbitraging prices across countries, basically. So we just put in massive market segmentation. Now, the literature, I don't know, I asked a bunch of people, is 3% crazy? And some say yes, and others say no, I don't know. But that's why that's happening. So fundamentally, we're resolving asset pricing puzzles that way. Is it the euro or the renminbi? I think that's a great question. Our view was that China has lots of TAOs of its own, and maybe the general message here is that the TAOs are bad for your anchor status, and I think that applies to China as well. There's sort of a few people have kind of touched on reserves and other reasons why the dollar is important. So there's a fairly straightforward extension of the model. Well, it seems, it's never straightforward when you actually try to write the model, but I think it would be easy to add an assumption that if you want to stabilize against the dollar, you need to hold some reserves in dollars. And that would then basically create a synthesis between this sort of reserve asset view of why the dollar is special and this sort of risk premium based view of why the dollar is special. And I think that would be a fun thing to think about, and that would also be a reason why anticipating that the dollar anchor is going to go away might have massive effects on the level of the exchange rate because people expect to be exchanging their dollar reserves. So that would be a fun thing to think about. There's an interesting question about, do you want to be the anchor, the dollar anchor? I just wanted to clarify the implication of the model. The implication of the model is conditional on being a large country. If you can't change that, conditional on being a large country where it's too expensive for you to stabilize against someone else, you want to be the anchor. Because essentially, this is sort of a magical thing that happens in the model where essentially it's welfare improving for small economies to stabilize. So they're obviously doing it because they're benefiting. And then the large economy is happy to be the target. Who's paying? Right? So it's there's very little frictions in here. So who's paying for all these gains of stabilization? The answer is it's the large countries that are not the target who are paying. So it's kind of not your choice. You're large, then you're basically paying a penalty in equilibrium if you live in a world where other people stabilize to anything. Yeah. Okay, what else do I want to say? Yeah.
Other question about uncertainty, I guess.
Okay.
Do you want to comment on that?
Yeah, so you can think about policy uncertainty here in a very simple way where you don't know what the tau is going to be. So if the tau has a variance, it's basically just as bad as having tau multiplied with relative risk aversion and modulo risk premia are important, then the policy uncertainty is just as bad as the policy in some sense, at least directionally. Yeah,
I guess I can add something. So there were a few comments about what does it mean by bad times. So in the sense that size, when the U.S. has a high demand shock or low supply shock, that's bad time. And there are comments about what exactly does it mean to be bad times. It could be that global risk reward is high and so on and so forth. I basically want to comment on that. Is that Tarek sitting here, you can see why we like size as the stand-in for this model, but that's really not not the only choice in the sense that you can think of other things where for example, when global risk reward is high in the U.S. is appreciating stuff like that. As long as that dollar safety depends on the dollar, its connection with the rest of the world, then the tariff going up and cutting the U.S. out of the global economy will have a similar effect. In that sense, the size kind of example, you can think of other things like trade centrality or a disaster and stuff like that. As long as the safety of the dollar depends on the U.S. The interaction between U.S. economy and the rest of the world, then the same mechanism here should also go through.
Yeah. So to John's comment, the normal. So we wrote this model basically with a laser focus on this one risk premium effect of tariffs. All the other rules about why tariffs are bad still apply. We just kind of threw them out of the model. So we have a homogeneous traded good. As soon as we have differentiated traded goods, all of standard results kind of apply here. So we didn't want to detract from that at all. Don, the trade deals with investments. So the stated goal of the administration. This has nothing to do with the model, but I just wanted to say it anyway. So the stated goal of the administration is to reduce trade imbalances. Okay, so you want to reduce a trade deficit, and then you go and you put a tariff to reduce the trade deficit, and then you go to the country and say, please invest even more in our country so that we can have a larger trade deficit later. It makes no sense, right? So we all understand that if you go and invest more in the U.S., the trade deficit will go up. Someone, maybe should explain that. I don't know where it is, the White House. And then Jay, so one kind of fun thing about, and Joe also, one fun thing about this model is the credibility of the stabilization kind of doesn't matter for the directional effects. So as long as you stabilize in some part of the state space, all the directional stuff goes through. And even if I believe that in some extreme case, Argentina is going to loosen the stabilization, I'm still going to react in the same directional way, at least. Tommy, did you have anything?
Yeah, we want to give Thomas a chance to weigh in. Let me unmute him there.
Yeah, I'm unmuted. I hope you can hear me. First, apologies for not being able to travel to Washington. We had an event here. I also want to mention the Fed disclaimer applies, especially with this topic. Okay, so a couple of comments on the discussion. First, in terms of the policy uncertainty, I agree that it might have been a mixture of various uncertainties that appeared on Liberation Day, maybe a resolution of what the tariffs are going to be, but potentially uncertainty about future policies. Now, if there's additional policies that might come up in the future, whether it's an increase in uncertainty right away, which is something we've seen in asset markets, or whether these are uncertainties that are going to materialize in the future, you would probably see the dollar move in the same direction. And the fact that we didn't tells us something about there being other forces at play than there usually would, I would think. Then I quickly wanted to say something about the simplicity of the model. That's, of course, a double-edged sword. And of course, you can quibble with the realism of the model in various dimensions. And thank you, Linda, for pointing out that there are also upsides to doing it, because it's very clear of what's really driving the effects here. And so I think we emphasize that part. And I think that's just important. But of course, we're not really capturing everything that's going on in the data. I just wanted to highlight one point that John made on the overall global welfare that you would get from free trade. If you go to the baseline model is first best without tariffs and without stabilizations. Now, some countries still find it optimal individually to stabilize their currency. And so somebody else has to pay. We know that from the first welfare theorem. So that is something that is going on in the model, and that's in the background. And lastly, I wanted to make one comment on Ben. So we looked at the allocations here in the model, but we also have a version that has a decentralization. And it is indeed the case that countries are invested in their equities and might short the bonds of other countries. So we do have an asset market stabilization, the decentralization here. Thank you.
Great. So we're all set? Terrific. Thanks very much. And we'll take a break now and come back at 4 o'clock for our star.